Hey everybody, this is Rudy for Investor Investor. I thought I'd maybe explore a little bit of the macro theme related to the economic situation that we currently find ourselves in. We saw Occidental, for instance, today dip below $10 again. Where is it going? Is it going to stay there? At the end of the day, you can sort of almost draw a line between the economic recovery and the demand for energy, and put them on the same y-axis, because at the end of the day, as demand in the economy increases in general, so does the demand for energy. So it's important to kind of know where we are right now. So I thought what I'd do is, just to start off with, is talk a little bit about this macroeconomic environment that we're in, using data from the Federal Reserve. So it's a good data source. But to start with, just a quick quote from Mark Twain, which you might be familiar with. So Mark Twain famously wrote, "It is October. It's one of the most peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, etc." You know where I'm going. Today is October the 19th, so we're kind of in the middle of October, that peculiarly dangerous month to speculate in stocks. So we don't want to be speculating anyway. We want to make sure that we are knowledgeable and informed investors. So let's take a look at what the Fed says in terms of the macroeconomic environment that we are in today. So the first thing is just to sort of set the background and sort of create a backdrop for what it is that I want to discuss. In the first place, is this recession version 2.0? So we've already had a recession that was effectively caused by the pandemic. It's just a few months ago. We had a V-shaped recovery. It looked like this in March, but soon after that, we saw a quick uptick. It's just 2 weeks to go before the US presidential election. Now, I'm not going to be as bold to suggest that the United States predicts or gives you an indication for the entire economy of the world, but at the same time, it would be amiss for me not to acknowledge the fact that sometimes when the United States sneezes, the rest of the world gets a cold. So we know it's just 2 weeks to go. We're going to see a lot of volatility, and I'm going to discuss that too in just a second. Many people are concerned about trouble ahead. Sometimes we are concerned about trouble ahead, and some of those fears are justified. Some of it is not really justified. We'll take a look at some of those reasons as well. A number of people, including subscribers and followers, have expressed concerns about a Trump re-election, but at the same time, many people worry about a Biden win in terms of what it might do to the economy, and especially if you're an energy investor, with Biden saying he will ban fracking, and then he won't ban fracking, and then he will ban fracking, and then he won't. So the flip-flopping doesn't do anything to inspire any confidence. So many people, from an energy investment point of view, are more concerned about a Biden win than Trump re-election, because the one is completely unpredictable because of Biden's flip-flopping, and the other one is completely or relatively predictable because of Trump's support for manufacturing and US energy independence. Others, quite rightfully, fear a contested election because if there's mail-in votes and there's delayed vote count and a variety of other things as the two major parties in the United States continue bickering, this might continue for a little bit longer than what we had anticipated. And you go back to a situation of Bush versus Gore in 2000. It's not a good situation. And these things create market uncertainty and volatility in the market. Let's take a look at some of the Fed data. So this particular slide, and unfortunately some of the good news is a little bit obscured there behind my thumbnail picture. But the fact of the matter is, if you look at FRED, so FRED is the Federal Reserve Economic Data. If you look at the initial jobless claims, what we have is a huge spike at the time of the sort of realization that the coronavirus or COVID-19 is a global pandemic. So you can see the timeline, or you might not be able to see the timeline because the writing is quite small. But going into March, April, suddenly a massive spike in jobless claims. But look what it's done since. So if you actually sort of just follow the graph in terms of where we are today, you say we had this enormous spike, but really it's done this, and it's continuing to decline. So as jobs come back, this is a leading indicator in the market in terms of where the economy is going. Another slide from Fred, and I thought I'll include this one, but I actually went back all the way to 1980. We look at industrial production, the total index. So what's interesting here is that presidential elections play a part, or do they? Because if I go back all the way to 1975, and I'll tell you why I'm starting here, is because at the time 1976 rolled around, this was sort of the first time in my life, or period in my life, where I actually started paying attention to US elections. In 1976, Jimmy Carter was elected as President of the United States, so around about there. He only served one term. And in 1980, Ronald Reagan became president, and he served 2 terms. So what you can do is sort of look at this graph, and you can say over a period of time, generally speaking, the industrial production of the United States, according to the Federal Reserve Bank of St. Louis, has pretty much increased in a straight line. So I mentioned Ronald Reagan became president in 1980. There's a couple of ups and downs during this period in time. He served 2 terms around about 1988. His vice president, George Herbert Walker Bush, became president. He only served 1 term until 1992, when Bill Clinton was elected president of the United States. And the upward trend basically continued. Bush became president this is George W. Bush, the son of George Herbert Walker Bush, became president in 2000. There was a dip. One of the reasons for the dip here was a recession that happened around 2000 with the dot-com bust and boom period, or boom and bust period, the other way around. In 2008, Barack Obama ran for election and successfully ran for president of the United States. Of course, we had this massive decline in the production index coinciding with the financial and housing market collapse. This was at the start of Obama's presidency, and the upward trajectory sort of continued. And once again, we had President Trump elected in 2016, and the upward trend continued once again, albeit more flatlined until there was a crash due to the coronavirus. So the reason why I'm mentioning all these presidents is because you have all these ups and downs, but at the end of the day, if you take the graph over a period, in this case around 50 years, it's mostly up, and of course you have these predictable gray lines in between, which are recessions. That's as it relates to industrial production. But this is an interesting chart because ABCP is asset-backed commercial paper. Now, asset-backed commercial paper, when debt was cheap, became something that attracted a number of investors and small entrepreneurs into flipping houses and buying properties they couldn't afford because debt was cheap. Well, arguably, since the huge crash, which was effectively almost entirely prompted by asset-backed commercial paper exploding because no one could afford to pay their debts when the market crashed. And this includes commercial paper, but it also includes housing, because obviously we saw the mortgage collapse in terms of people just walking back to the bank and saying, here's the keys to your house, have a nice day, I'm no longer living in the house, and you own the house anyway. Because in the American dream system, which is emulated in many countries across the world, you actually never own your house. The bank owns the house, and you just rent it from the bank for an interest rate, which is arguably right now super cheap. But if debt is so cheap, it's interesting to see how consumers are behaving, because the asset-backed commercial paper graph just keeps declining in terms of outstanding debt. What about the small cap total market index? Because it's always the small business owners who get whacked the hardest when there's a huge market collapse. So the little collapses related to the previous presidents that I had mentioned on these gray recession lines are so insignificant they're almost difficult to pick up. And you see, when Bush became president in 2000, there was a nice upward trajectory until the collapse of 2008, the fiscal and housing market collapsed. And then after that massive collapse, there was a nice upward trajectory again until the coronavirus collapse, even though there were a couple of mini collapses in between. I think there was a correction in December of 2019. So very volatile under President Trump, but still at the same time a fast-moving upward trajectory. So let's talk a little bit about these fear factors and their antidotes. The fear factor is we have a virus and a pandemic all at the same time. I mean, at the end of the day, the pandemic is caused by a virus, but to be fair, we have a virus and a pandemic. However, we see the daily infection rate, which is rising steadily, but at the same time, for months, the mortality rate keeps going lower and lower and lower, and that might explain the relatively muted market response to the rising infections. In other words, people are basically saying, hey, you know what, to a degree, and I don't want to minimize this, but to a degree, you get a coronavirus infection, you kind of get a mild or severe dose of flu, and then generally speaking, you get better. Unless you are older or have pre-existing conditions, at the end of the day, the coronavirus is a flu. So you get an influenza-like period, and maybe it takes you a week or 2 weeks to recover, and then you're okay. So people are no longer that scared of the coronavirus. So the fear factor has been relatively muted, relatively speaking. In addition to that, the health services are no longer completely overwhelmed, and we've seen some improvements in terms of our ability to be able to handle and treat cases. The worst case scenario there is if there were to be another round of lockdowns. That would not be cool at all. The other thing that's happening is there's continued talk of an additional fiscal stimulus bill. And this is not related specifically to the ECB or the United States. This is pretty much just all over the globe. Governments are just printing money as if it's going out of fashion. And if there's another fiscal stimulus bill that's approved, or if there's fiscal stimulus that floods into the market, you could experience another spike in the stock market again just because of that, and regardless of all the virus, pandemic fears, the presidential election, and all that kind of stuff. What about the volatility index? Because the VIX specifically measures your fear. Well, yours and mine, to be fair, but as a general optimist, I'm not necessarily all that fearful. So I survive, perhaps because of my optimism in the marketplace in general. But look what happens sort of again over time. So this graph starts sort of in the early 90s, and in the early 90s, of course, Bill Clinton became president. You see some fear spikes here. Probably people realistically saying like, wait a minute, you know, like this dot-com boom is fantastic, and the market doesn't really work like that. Somewhere along the line, something is going to crash, and it did. But then after the crash of the dot-com bust, fear spikes again. Why does it spike this time? Well, there are things like midterm elections and other things coming into play. Countries are continuously at war. There were all this talk about collapsing economies, like, you know, Greece is going to default any minute on its debt, and Greece's economy is smaller than the city of New York, but anyway, that's how the market works, right? Then we see the actual collapse of the stock market as a result of the financial and housing collapse of 2008, 2009. But what happens after that? Fear spikes off the chart. In fact, it's never been that high again. And then we see a couple of spikes again, sort of in between. One of these spikes, particularly the one over here, is if Trump is elected, then everything is going to crash and we're all going to die. Of course, that didn't happen. And then you see volatility spike again as we enter the coronavirus period. But the volatility index, ironically, seems to follow the recession period as opposed to leading up to it. So you have to be careful if everybody's happy, because when everybody's happy and the market's going up, they're not fearful enough, and the spike in the stock market happens, and then the recession happens, and then after that everyone's afraid, and that's actually when the V-shaped recovery typically takes place. Just one more. So if we look at the real median household income, and that's a good indicator, right, because this is sort of how much money is in my pocket. And I'm just going to be bold enough here to use the United States as an indicator for the rest of the world, just generally speaking, and the source is the United States Census Bureau for this particular graph. So we see the graph go up and down, again with different presidents, and we see an enormous spike in household income. Remember, Trump was elected in 2016, and look how household income has spiked under Trump's presidency. So this, as a general rule, for the average typical consumer from a household income point of view, has been good. The period of Trump's presidency has been good. From a household median income, this has been good. So from an optimistic point of view, if Trump is re-elected, we can expect this graph to potentially continue regardless of what happens next, as long as there's not another lockdown. In closing, the recession concerns are valid, but we should take care as investors not to pay too much attention or place too much importance to the political cycles while we ignore the business cycles. There are companies reporting, and they're reporting their quarterly results, which in itself is relatively meaningless considering that some of these companies reporting the quarterly results are like 100 years old, right? So when you have investments like I do in companies like Pfizer, pharmaceuticals, the company has been around literally for 100 years. Does it really matter what happens from quarter to quarter? The answer is no, but that's not how the market works. But pay attention to the business cycles. If you're concerned about the fact that Occidental Petroleum today just hit like $9.89 on a closing price again, just remember that the political cycles and the virus and the pandemic and the lack of demand for energy might be driving the price down. But don't ignore the business cycles, and let's see what happens when Occidental reports, I think on November the 2nd, their third quarter. So that's just an example, right? So we don't want to be surviving quarter to quarter. Just pay attention to the business cycle rather than placing too much importance on the political cycle. Recession version 1.0 was caused by the pandemic. There was not a business cycle displaying structural or cyclical imbalance. In fact, as a general rule, business is good. The economy is strong, and it's been fueled by the fact that debt is super cheap. And that's not necessarily a good thing, but it's just a matter of fact. However, one of the most important key economic indicators is jobless claims. And more than half of the US jobs lost to the pandemic have been replaced. As long as we don't have another lockdown, which would be terrible, things could be good. And this is a critical point too as it relates to the US election, because if Trump is elected, he has already said he would not want another lockdown. If Biden is elected, he has said we would shut the economy down until we have a greater sense of recovery. You cannot take too much credence from any politician when they speak, because as a general rule, you know they're lying when their lips move. However, as you can tell in terms of the general thread throughout this presentation, I remain very, very optimistic, albeit relatively optimistic, because I cannot predict. I cannot predict what will happen in the election, and I cannot predict what will happen to Occidental when they report their third quarter, but at the end of the day, I remain optimistic. I am a long investor, and I hold the stocks that I hold because I believe it will pay off in the long term. So on that happy note, take care. Please subscribe if you like my videos, and I will see you again soon with some more news about Occidental and more. Take care. It's Mr. Oxy signing off. Best Investor saying goodbye for now. Thank you.